Hi, good afternoon. This is Corey Parnell, and we're going to wait a few minutes as people continue to log in for the webinar and appreciate you joining the call. And what I would ask is, as we're going through the presentations, if you have any questions, please submit them, and either we will try to address them as we're going through that particular slide or subject, or we might set it aside until we get to the end. So if someone wouldn't mind just sending maybe what state they're from or the temperature. Both Brandon and I are in Minneapolis, and I think we're at a balmy 30 degrees. So that's actually a nice heat wave here in the Minnesota area. Again, if anybody could just send us a question or what area they're from or the weather, that then we could just make sure that our Q&A is coming through on the webinar. Thanks. We got one from Illinois, snowy. So appreciate that. And it seems like we do send our weather your way. So appreciate that. And then we've got someone from Nebraska. They're saying it's a little cold and snowy there. And someone in Colorado, 36 and sunny. Always enjoy our visits in Colorado when we get there. Then we've got someone from Las Vegas, Nevada, 52 degrees. I'm much surprised. A friend of mine that's a public accounting CPA is actually in Nevada right now, enjoying his leisure out there with his wife. Hopefully doesn't leave too much money there. And we'll just give it a few more minutes. I think we'll kick it off, and as people join. But again, we appreciate you guys, everyone that's taking the time to join the webinar today, and hopefully you get some information out of it. This will be recorded and posted on our website, so if you ever want to go back and re-listen to it. And I'm joined here with my partner, Brandon Van Asten, and he's one of our leading experts in this area. So if we can just jump another one. So first, I want to give a little background about Bridge West itself. We feel that we're one of the leading cannabis and hemp CBD firms in the U.S. here. As you can see, my partner Jim Marty actually started the practicing with cannabis clients in 2009, so we'll be going on our 11th year, which in this particular industry is like dog lives, very long. And we've guided over 400 U.S. and international cannabis and hemp businesses. So we have over 400 license holders that operate in pretty much every state that there's some form of legal cannabis or hemp. And we've worked with cannabis clients that are organized and operating out of Canada that have come into the U.S. and that they've done some either acquisitions or work with the U.S. operators as well. And then We belong to many associations. One that we're probably the most active in is one called the NCIA, National Association. And I would highly recommend that you would go look at their website. They have a lot of benefits for members and very active in the industry and specifically probably within your state. So I'll introduce myself and I'll let Brandon give a little background about himself. But as you can see, I've been working in the public industry for about 25 years or over 25 years and really got involved in the industry in 2015. I was introduced to Jim Marty through the National Association of CPAs, the AICPA, because Jim is one of the leading CPAs and has worked with that organization trying to figure out how CPAs can work with cannabis organizations because it's federally illegal. And again, I've been advising clients since 2015 in the area of the cannabis hemp industry since then. And one of the key things that we always like to say is that we're capable of not just learning with you, but actually probably leading you through all the issues within this industry. So, Brandon?
Yeah. Hey, everybody. I'm Brandon. I'm a manager with Bridge West, and I really started my career in financial statement auditing and have really transitioned into more of a consultant role. So I work a lot directly with the actual operators at these entities, whether it's a cultivator, extractor, etc., and do a lot of work around inventory costing, inventory management, helping with 280E mitigation, and it looks like you guys might only be able to see the main slide. I want to just check on that. Okay. Thank you for notifying us about that, Kent. Appreciate it. So you should be all right. All right. We got multiple confirmations. You didn't miss much, but again, I work a lot with inventory costing, inventory management, and 280E mitigation. So figuring out what costs we can bring into inventory and eventually through cost of goods sold. And I also have been, over the last year or so, working a lot more with some hemp and CBD clients as that part of the business has really started to take off. So wear multiple hats and really love the work that I'm doing here. So we're going to go over a few different things today. First, we'll kick it off with some general comments on the industry and the accounting landscape there. Then we'll do a brief intro into what 280E is, and then we'll move into how we would recommend, or one of the ways at least, of setting up an accounting system to be inventory friendly. Then we'll look at determining how we go about tracking production activity, because that's a major component of determining your costs. And then lastly, we'll kind of look at some inventory management insights and provide you an example of what two different companies might look like under different inventory production scenarios. So as for a general overview, really there aren't any legacy accounting systems or accountants in the industry. And what we mean by that is we've got startup companies popping up everywhere, and there just isn't really a good strong base of accountants out there to serve with those companies. So the knowledge base is pretty new, and we are hitting on multiple different industries even within one company. You can be looking at an agricultural company, manufacturing, retail, distribution, etc. So it touches a lot of areas, and the expertise might not be that strong in all of those areas at our clients, at least. We see about 95% of the operators out there using QuickBooks as their accounting system, which has its benefits and disadvantages. It really, with QuickBooks, there is not a strong inventory module, especially when touching on plants. It's just not out there with QuickBooks. And even with some of the other accounting platforms that are available, they're pretty new, so there are bugs in the systems. Even within some of the point of sale systems out there, people are building these software packages from scratch a lot of times, so there's not a lot of validation of how they work. And lastly, there are several different seed to sale tracking systems out there. They vary by state. Most states require a certain one, and sometimes operators put a little bit too much reliance on those systems and have higher expectations than what they actually can fulfill from an accounting standpoint. The seed to sale systems are really built for state compliance, and that's about it.
Yeah, just a couple things I want to take on to what Brandon just said is to give you an idea, we have one client that went to a Microsoft product and worked with a consultant, and they were a small grow. I think they ran about between the rooms, they were only growing about 500 to 750 plants on hand at all times, and then processing, but they were a high quality product. However, they hired a consultant group that said that they've done manufacturing before, chemical manufacturers, and not a problem. They sunk about $200,000 so far into trying to get up and running on a Microsoft product with inventory modules integrating with, in this particular case, Matrix, and it's still not functional. And that's where we say beta stage, that there's quite a few consultants that say they can implement inventory modules, but again, they're probably learning the business and not having a lot of success out there in the marketplace is what we've seen. So just want to go over what is 280E, just kind of as a foundation, because that is a significant impact, not as big of an impact on growers and processors as much as a dispensary or retail, but it is still a significant impact on the cannabis industry. And essentially in 1982, there was, I refer to him as a drug dealer that went to court against the IRS, and the IRS lost. So essentially that drug dealer, he was able to deduct home office, his car, airfare, all expenses associated with selling drugs. So essentially Congress did not like that. So in the case was in 81. In 1982, Congress came out with a rule, 280E. And essentially what 280E states is that no deduction or credit shall be allowed for any amount paid or incurred during the tax year in carrying on a trade or business, if such trade or business consists of illegal trafficking. And so far, because marijuana is Schedule 1, all the activity associated with that is considered illegal trafficking. One good thing is there's a Champ case that the government conceded that 280E does not prohibit a taxpayer from claiming cost of goods sold. One thing I would recommend is back in December, we did a webinar on 280E mitigation. So if you wanted to go to our website and see that webinar that's posted on our website and give you a much deeper look at what 280E is. So the next PowerPoint presentation just gives you kind of an idea of a legal business. You have sales, cost of goods sold, gross profit. Then you can deduct selling, general and administrative. You have net income before taxes, income taxes, then net income. In what is defined as an illegal business from a federal perspective, might not be from a state, but from a federal. Basically, all of your selling, general, administrative is disallowed. So if you can imagine if Walmart was trying to operate and survive off of paying income taxes on their gross profit, not deducting their store expenses, store employees, or administrative expenses associated with that, they'd be very challenged to kick off net income.
So now we'll start kind of talking about setting up your accounting system to be cannabis friendly. And most of this is focused on the P&L, but for the balance sheet, you can go about it in a few different ways. You could have one inventory account for everything and just have your subledger or detailed calculations tracking the balances between the inventory classes. But typically we have a few different, maybe 4 groupings of inventory on the balance sheet: plants, WIP, finished goods, and purchased finished goods. On the P&L, this is where it's crucial to be tracking your expenses by costing department. So if you're one of the 95% that is using QuickBooks, they have a nice feature in there where you can record expenses by class, and you can name those classes to be something along the lines of cultivation, processing, or an extraction, packaging or manufacturing, and then security or overhead, which would all be inventoriable classes. You might then also have a dispensary or SG&A class for your non-inventoriable expenses. So what setting your P&L up by class allows you to do is directly record your expenses as they come in to these departments. And then also it allows you to, at period end, do some allocations of some expenses that might relate to multiple costing buckets of your business. So an example of something might be rent, for example. A portion of your rent should be going towards cultivation, a portion should be going towards your office space that's in that facility. For all of the THC cannabis companies that we work with, we do follow GAAP accounting because you're able to include more costs as inventoriable, which is how you would get the deduction through cost of goods sold. And I guess a key difference, or maybe an analogy, would be comparing a cannabis company to a traditional manufacturer. And for example, something like time spent doing inventory management tasks, or time spent, or even like the rent of an area of a facility that is related to something like security, if you will. You really want to be going through your P&L account by account, transaction by transaction, and making sure that you're bringing as much into the inventoriable costing buckets as possible. And maybe a better example would be something like insurance, which a traditional manufacturer would likely just have as an SG&A expense.
Yeah, that's one thing, need to address all costs versus a traditional manufacturing, because again, if it's below the manufacturing cost, if it's below that in the SG&A, then it's really non-deductible. So it's very important that you go through and you look at what really should be up in the manufacturing category, or what can be up in the manufacturing category versus down to SG&A, because it's non-deductible. And again, like my traditional manufacturing clients I've worked with before, for example, we see this a lot in the startups, is you might have a president or CEO during the startup phase that's really working or spending a lot of their time in the different departments, whether it's the cultivation, the lab or processing, or the packaging department. And the one key thing is, if you do allocate those to the different buckets, you have to have a methodology, which we've developed in order to document, how did you come up with the fact that this person was spending time in any of these departments, because the likelihood of being audited is significantly high within this industry.
Yeah, so a big part of it is documentation, just supporting your stance on your allocations. So whether that's a floor plan or payroll detail or whatever it might be. So this slide is showing how those different costing buckets are applied or can be applied to inventory. And what you're looking at here is really a summary of a period for a sample company, and it's purely the cost components and how the costs are moving from raw materials into plants. And I guess if you focus on the plant column, we're starting with 520,000 of plant inventory at the start of the year. And notice how we are bringing in all 2.1 million of cultivation expenses. And through the inventory calculation, you're ultimately looking to value the plants that are still alive, which I'll go into a little bit more on the next slides. And the remaining of those costs is pushed on to the next stage. So this is really an output that allows you to better visualize the movement of inventoriable expenses through inventory and eventually out through cost of goods sold. So some of the key units of measurement are for plants. We typically are looking at the number of growing days that have been incurred throughout the year, and then allocating or determining what the cost per day per plant is. And then looking at the plants that are alive at the end of the year, seeing how many grow days have been incurred by those plants and multiplying it by that cost. And you'll see an example of this on the next slide.
One thing, Brandon, I want to mention is we do have some of our larger clients that, with the larger grow facilities, we actually will go in and break down the different rooms. So whether it's the clone room, the veg room, or the flowering room, or the drying room, and then look at specific costs associated with those and being able to track those through the system as well. So it can be very complex, and again, if you're trying to manage specific expenses and figuring that out, it can be broken down even further than just the cultivation area, and we've done that before.
Yeah, and really that comment applies to everything regarding the inventory calc. Is you can simplify it, and you're essentially reducing the risk of making an error by doing that, but you're not getting as accurate of costing data. Or you can get really detailed with it, which just requires you to be a little bit more diligent in doing that calculation, but getting, in theory, better information or more precise information regarding your costs.
So as you can see, there's the WIP for the plants, growing days, the WIP, the harvest plants, the yield. Again, bud versus trim shake. We have clients that we do break apart the cost of the yield and allocate the cost to the buds because they might be made into a flower component, and the trim and shake, and maybe some of the poor buds will be allocated because that'll end up being processed into an oil. So again, we've come up with the methodology in regards of, when you harvest this pool of plants, and this amount of the yield is being moved over to made into a flower product versus oil, you have to be able to break those costs apart. And then you've got the whip, the processing. That's again, Brandon, you'll see in here. You can the whip processing. We've got it where clients have anywhere from I think it's 2 or 3 stages up to 5 or 6 stages of producing the oil. And then again, you've got the finished goods where they're taking either the bud flower or the oil and taking that and either rolling joints, for example, or putting the oil in vape pens, or you might have edibles, things of that nature.
Yeah, and every client is different. In the area of the processing or in the lab, that's really where you get the most variability. A lot of clients that are in adult use markets have several different extraction methodologies. So there might be a CO2 extraction. There's likely going to be a crude to distillate extraction. You might have some live resins or hydrocarbon extractions, and then you probably have some rosin creation. So there's completely different ways of extracting the plant, and the input can be different and the output is going to certainly be different. And in addition to just flower and trim, if you're making the live resins or shatters, you might be using fresh frozen flower, which has not been dried or cured before it's being used as an input. So you have to take all of those sorts of things into consideration for the specific client and the operations of that client.
Yeah, and again, a perfect example is we've got a client that now they're going to a water-based treatment. So some of their yield or some of the plants they're harvesting, they're just going straight in because through a water-based you don't dry the plant out, and then the other components. So again, there's multiple steps in tracking that need to be figured out and worked with the operators.
Yeah, so it's not a cookie cutter, one template works for all kind of scenario. So here on the left side of the screen, you're looking at an example of a plant valuation. And what we're doing is we're determining the total number of good grow days incurred by the plants, which is about 1.9 million. And we're allocating all of the cultivation expenses incurred year to date against that total number of grow days to determine that it's about $1.70 per day per plant to grow. At the end of the year, there's about 437,000 grow days associated with the plants that are still alive. So we get a plant valuation of $740,000 by multiplying those two numbers.
And just kind of touching on what two things here is a lot of clients will ask us what's a good benchmark for the cost per grow day, and there's really no normal or standard that we've come across, only because the costs associated or allocated or part of the cultivation can be greatly different. So one of the ones that comes to mind is we have quite a few clients that have done a sale leaseback, so there's significant rent increase associated with that. So that'll drive up the cost. And then we might have someone in upper state New York versus someone down in Arizona, and you have completely different costs. The labor market's a lot different. So it's really understanding what the breakdown of those costs are and how to manage those costs associated with the cultivation.
So continuing on, if you incurred or had year-to-date expenses in the cultivation costing department of $3.1 million, and your current plant valuation is coming in at about $740,000, that would identify that about $2.4 million of costs have been associated with the plants that have been harvested. And that's not a plug. The good grow days that we're allocating over, another way of thinking of this is that it's really the grow days associated with the plants that have been harvested and the grow days associated with the plants still alive. The plants that died or were removed because they might have been male or they just were weak plants, they're not expensed as they're removed. They're absorbed into the plants that survive and ultimately impact your average cost per yield from those plants. So in this kind of simplified example, we have 2.4 million of cultivation costs leaving the cultivation department and moving into the flower yields inventory bucket. So you can see that cost move over into flower. We had about 1.3 million grams associated with those yields. So our cost per gram in the current year was $1.79 per gram. But we have a beginning balance at the beginning of the year where inventory that's in the flower stage was 178,000 at $4.75 per gram. So in this sample, we're showing massive improvement, which is not uncommon to see huge fluctuations in cost per unit, especially in these startup stage companies. And ultimately, then we're transferring on our flower inventory into the next stage at the new weighted average cost per unit. So that process just kind of continues on, and it's important to be able to work with the operators because a lot of these numbers are coming from the seed to sale systems, and you just need to be verifying that information is accurate and in line with their expectations, both from a yields percentage perspective and from a quantity in total. So in this case, we've got an 86% conversion rate to decarb. Typically, I would expect 90%, so we're a little bit off, but it looks pretty good. It might be something that I would question the operator on. And then this kind of just continues on, and you might have different paths. This flower might not only go to decarb, it might go directly to a live rosin extraction, or it might be packaged into pre-rolls or packaged finished goods. So it's uncommon for there to be one path for this inventory. But continuing on, just to kind of give you an idea of what this might look like on a more practical level is, if that decarb was converted into an oil, maybe eventually a distillate, and ultimately, before being packaged into finished goods, it's probably going to be formulated to meet the company's standard for that product. So the costs of the oils at different stages can vary greatly because the more concentrated an oil is, the more valuable it's going to be. But then you also have your lab or extraction costs hitting these costing buckets at different points in time. So you can see for the concentrated oil, 1.4 million of costs hitting that bucket, and only 87,000 hitting the distillate costing bucket. So it's not just about the quantity that's processed through it, but how much does that equipment cost to run, how much labor is incurred for that equipment, how much space does it take up, etc. So you have to understand how the extraction process works at your specific company and tailor the inventory calculation to that specific operational scenario. Ultimately, you're going to move on from this oil stage and you're going to be looking at finished goods. So you're at this point, now you've moved into your next costing bucket on your P&L away from extraction and into your manufacturing or packaging. And this is a case of a vertically integrated company, which you might just be a component of this. But we're then bringing in that determined cost per gram for the various oils that are in these finished goods, and then looking at the year-to-date production activity of each of these finished good creations to determine how much cost of the oil should be assigned to each finished good. In this case, we're taking a very simplistic approach with our manufacturing costs, and we're treating all finished goods as equal, and we're just allocating the total packaging and manufacturing costs across all units of production. And that's how we're determining our total manufacturing cost for each finished good. Ultimately, then you're getting to a cost per unit, and then you can multiply that by the units on hand at the end of the period to determine your finished good cost.
But again, probably one of the biggest challenges going from the crop to the lab to the packaging is really working with the cultivator, the department head for the processing or the lab, and then the packaging group on aggregating or accumulating the right data that's needed. And then again, in the finished goods area, if you want to get more granular and specific, that's possible to do. Just have to build a bound by product or SKU item. And so right here, all we're just trying to do is show you a higher level methodology in the space.
Yeah, and typically it's good to start simple and then make improvements as you go. So as for management of inventory levels, we would highly recommend that monthly counts are being performed directly to the seed to sale tracking reports. So there are some caveats with that. If you're running on Metric or LeafLogix, for example, you need to be running that report at the end of the day, last day of the period, because you cannot run a report today as of 12/31. So hopefully that kind of gives you some insight into some of the nuances with these inventory tracking systems. They're not built for accounting purposes, so you have to be well aware of what those quirks are and how to work around them. And each seed to sale system has its flaws, whether it's BioTrack, LeafLogix, Metric, MJ Freeway, Trellis. They all have flaws to them. None of them are the perfect answer to inventory tracking as well as accounting, but some are better than others.
And again, a couple things. One is, again, the need to really be talking with the cultivator, the operators of the various departments. So one thing that comes to mind is in conversation with one client, in the cultivation and the general manager of the facility, it was determined when they took account, looking at the report, it came up the fact that they had a big batch of plants quarantined because of odor issue. So you wouldn't be able to see that on a report. However, it was tubs of yield that were identified and set aside. And then kind of the same thing on the finished goods side is, let's say they've got product that either came back or they had issues with, and they can't sell it. However, in one particular case, I know that the state did not have a procedure for destroying that product yet, so it kept accumulating in the quantity counts. But again, when we're talking to the person that was running that area, they're like, oh, by the way, all of these products on your list, these are not any good. We're just waiting to hear from the Department of Health how we can destroy this product.
Yeah, so we see some of that wastage when clients are overproducing, which is not uncommon. Overproduction is going to lead to a lower cost per unit and higher gross margins, which means a higher tax obligation. And because of the long lead time, you want to be avoiding any risk of underproduction. You're probably looking at about 5 months from the time you plant a seed or take a clone to the time that you could get a finished good on your shelf. So there are some nuances with managing those inventory levels and making sure that you have enough inventory on hand while still trying to not overinflate your gross margin. due to tax reasons.
Yeah, and I tried to pull together just kind of an example. There's a lot going on in this particular slide presentation. However, some things I'll just key things that I'll point out, and then there's a quick summary on this. But operator A inventory level grows, and to be very honest, this is more of a common theme that we will see within the industry, and then we start working with our operators. Where they're the cultivator and processor. So as you can see, I'm going to work left to right on the cultivation, and these are dollar values in the first column. The plants, there's a value of $200,000. There's manufacturing expenses of $1,750,000. There were plants that were harvested $1,652,000, moved over to the bud trim area. And our ending inventory was $297,761. So in this particular example, the growing days was 95,000, production was 837.5, transfers next stage was 790, ending growing days was 142.5. So as you can see, and it's a common theme, moving left to right from the bud to the trim, the refined oil to the finished goods. I'm basically, it's almost, it's increasing the quantity of the inventory as well as the value of the inventory grows from 600,000 to $1.1 million, even though your production manufacturing expenses were 4.4 million. Now I'm going to slide over to the right. The operator B inventory does not grow. So, in fact, you'll see the plant value on the cultivation is 200,000. The same $1,750,000 is the manufacturing expense. We moved $1,766,000 over to the next stage, and then we ended up with inventory of 183. And as you can see, the number of growing days went down. But one thing to point out is if you compare the operator B, the production cost or growing day cost is $2.42 compared to the operator A under production is $2.09. So, and again, just understanding what does the cost per growing day, what does that mean? And also, we've seen it where it might not be growing day, it might be they measure by week as plants move through rooms. So again, as you can see, the production level is down, so the inventory level came down. However, our cost per unit did go up. So going to the far right part of the screen, our beginning inventory value is $6 million. We incurred the same level of manufacturing expenses, $4.4 million. However, our cost of goods sold in this particular case was $4,168,000, and our ending inventory value was $831,567. So two things happened there. As you can see, our inventory only grew by I think it's about $280,000. And that is primarily because even though our quantities came down on operator B, our production cost per unit increased. So that's why you might have expected or thought, you know what, I'm going to end up with a bigger gap, but it's not as big of a gap. So what does this really mean in regards of cash flow for you then? And if we go to the next. So two things. One is the amount of tax that you're going to pay as operator A is you have a larger gross profit. So the sales are $7,780,000. My cost of goods sold or cost of sales is $3,889,000, or gross profit of $3,890,000 times 31% is $1,200,000. Operator B, and what I did there is I just made sure that my production through the year, I ended up selling the same number of units. So my sales number is the same, 7,780,000. My cost of sales is 4,168,000. My gross profit's 3,611,000. So my income tax is 1,119,000. So on the surface, you might say, well, yeah, my cash flow under this is, I'm better off by $86,000, but that's not that big of a number in relationship to manufacturing expenses of 4.4 million. However, if you do that again, another year, and we've had clients where we've seen it, where their inventories ballooned to $2.7 million, there's a lot of tax money that they've had to pay, and yes, they're showing great gross profit. However, it's costing them money. Then one other thing, if we could just go back one slide, 1 second. One thing that we constantly work with clients on is the 4.4 million, because it's not gross profit that they have to figure out how to manage. It's their operating expenses and understanding all the costs that are being allocated up into the manufacturing expenses. Which ones are fixed, which ones are variable. And controlling that will help the cash flow, the overall cash flow of the company, versus if you just purely look at the gross margin. And this is an exercise. Again, I apologize, there's a lot going on the screen, but this is a client that we came in to start working with, and they were already operational. But we were doing inventory calcs for them, and we kept hearing that the lab, the processors, they're like, well, we have to continue producing at this level to make these finished goods by the demand that's coming through the dispensary. And one of the components that was really being ignored is they were just looking at, can the lab produce this level of inventory? However, I'm going to go left to right. The very first line item, plants, the red number, 2,805 plants. And let's say there's a failure rate of 8%. So the plants expect to be harvested is 2,580. And we're going to get 300 grams per plant. That means our yield, just from the plants they have in process right now, will be 774,000 grams. And currently they have in their storage already is 131,000 grams of yield. So they really have a future of 905,000 grams of yield. And I'm going to kind of jump down to the finished goods column. So this is just kind of showing the different stages, and they called it pure, refined, and bulk, and then finally the bulk was made into finished goods. So if they harvested all these plants, converted all the yield grams into the final bulk oil, and then converted that into finished goods, they would have about 36,000 grams of finished goods. And they were estimating that their growth grams per month of sales 3 months out would be 1,565. So what we were pointing out to that particular client is you really have about 23 months worth of inventory. And that's even if you just stopped growing, which cultivators love to grow plants, and either the lab takes it and processes it, or stores it in a vault, or it sits in as yield in tubs throughout the facility. So in this one, again, the dispensary was saying this is how much we need. The lab was producing at that level, but the cultivation and the buildup of the yields was significant.
I'll also just say on this, 300 grams a plant is not average. They're far above average and include trim in that number for this one.
So just wanted to touch on any additional services that we offer. As you can see, the accounting setup. We have a standard chart of accounts, the departments, inventory, the costing and tracking. Again, we have a team of 3 people that's what they spend their time on is in this area working with clients. Employee classification, what that looks like, how you document it, department costing, the allocation, what's your process, and how often should you reassess it. We do have an outsourcing group that does monthly, quarterly accounting, as well as monthly, quarterly controllership services as well. We worked with clients on internal controls over cash and inventory. The 2 highest risk assets that the company has is cash and inventory. For Form 8300, we've helped clients become compliant with filing those forms. We had a client out west that was looking to sell, and that came up as an issue for the potential buyer, is that these forms were not filed. What the Form 8300, just real quickly, is if you are paid $10,000 or more in cash, you need to file a Form 8300. And I always get the question, well, what if the client pays me $3,000 over 4 months? Then I wouldn't have to. No, it's looked at an aggregate. And we even had a client that had multiple entities that when they paid us, we exceeded the 10,000. So it's better to file it than not to. Sales and use tax review audits. In that particular case, there's quite a few states that if you meet the manufacturing requirement, you can get a sales tax reduction or rebate. IRS and state audits, we've handled over 36 IRS and state audits on the 280E. Business valuation, we've done that, everything from stock options to division of or a breakup of partnerships, as well as acquisitions or just a general calc value for people that are either looking to raise money, and then also tied to a conversion from a nonprofit to a profit. Other 280E reduction strategies, again, you can go look at our website and listen to the webinar on 280E mitigation. And the last one listed here is filing protective claims. There's additional services that we do, but these are just some that we wanted to highlight for everyone. And I don't know if anybody has any questions. So we're really at the end of our presentation. And if anybody has any questions, I can't believe we did that great of a job. But there's a question about specific costs of a CPA doing the year-end inventory observation be allocated to the inventory cost. We'd have to talk about that one internally. We haven't seen it. I would probably lean against no. But if it's tied to an audit, then I would say no. If you're just there helping you with inventory management, then it could be. So again, facts and circumstances. The question was, can the specific cost of a CPA firm doing the year-end inventory observation be allocated to the cost or manufacturing cost? And my answer is no. However, if you had someone coming in and helping you manage your inventory or coming in and periodically doing inventory counts, that would qualify. But not in this particular question is related more to an audit that the CPA would be either opining on or providing to someone. Okay. Well, again, we appreciate everyone's time, and hopefully you got something of value. If you do have any other further questions, you can see both Brandon and I, our contact information. Either you can email or give us a call. And I hope you guys have a good rest of the day, Brandon.
Yep. Thanks for attending, everybody. Have a good day.